The structural mechanics of wealth preservation and accumulation during global economic dislocations. Modern economic history demonstrates that major financial collapses are not isolated accidents but predictable redistribution events. The distinction between generational wealth preservation and middle-class capital erosion lies in the period of preparation rather than the moment of reaction. Sophisticated institutional investors typically initiate a specific playbook approximately 18 to 24 months before a market peak concludes. This strategy relies on the accumulation of 5 specific asset classes designed to thrive when traditional equity and debt markets falter. The first critical asset class involves short-duration government paper and cash equivalents. Institutional data from SEC 13F filings consistently reveal a rotation into 90-day sovereign instruments prior to major volatility events. Short-duration treasury bills serve as a lethal tool in the language of institutional wealth because they represent absolute liquidity. This preference for liquidity is often misinterpreted by the financial press as a missed opportunity or overly conservative behavior. However, the strategic accumulation of cash is not about yield, but the ability to convert into distressed assets when prices collapse. During the 2008 financial crisis, while S&P 500 companies lost significant value, holders of liquid sovereign debt maintained their principal and gained immense purchasing power. Cash acts as the only asset that scales in value relative to the market at the exact moment other assets are losing their utility. The second pillar of pre-crash positioning is the strategic acquisition of distressed debt. Economic crises serve as a transfer mechanism where productive assets move from dispersed public shareholders to concentrated private capital. When a corporation approaches insolvency, its publicly traded bonds often trade at a massive discount to their face value. Sophisticated investors recognize that distressed debt is not a gamble on survival, but a legal mechanism for asset seizure. The legal hierarchy of bankruptcy places senior secured debt holders at the top of the recovery waterfall. When an entity is restructured, old equity is frequently eliminated and debt holders emerge as the new owners of the physical infrastructure. This mechanism allows for the acquisition of factories, logistics networks, and real estate portfolios at a fraction of their replacement cost. High net worth individuals utilizing alternative credit strategies historically outperform diversified portfolios during recovery phases. The third asset class, characterized by extreme resilience, is productive agricultural land. Farmland maintains a value floor rooted in the biological reality of caloric necessity. Human demand for food remains constant, regardless of central bank policy or currency fluctuations. Historical data shows that prime agricultural land has consistently appreciated across multiple decades without the volatility seen in REITs or commercial real estate. Wealthy individuals accumulate land as a hedge against the disintegration of paper monetary systems. Productive capacity anchored to global export demand, such as coffee or cacao, retains international value even when domestic currencies fail. The ownership of vast tracts of farmland represents a claim on future caloric output that transcends the jurisdiction of failing monetary authorities. The fourth asset utilized for wealth preservation is blue-chip fine art. The primary characteristic of this asset class is its near-zero correlation to traditional equity markets. Unlike financial instruments, the supply of works by historically established artists is finite and cannot be expanded through quantitative easing. When fiat currency supply expands rapidly, capital flows toward assets with absolute scarcity. Fine art returns have shown remarkable stability even during periods when major stock indices face double-digit declines. A significant portion of this market operates through private treaty sales rather than public auctions. Direct negotiations outside the public eye allow for the transfer of assets at negotiated prices that avoid market sentiment fluctuations. This opacity is a central feature that protects the valuation of high-end collections during broader financial stress. The fifth and most aggressive asset class consists of essential service monopoly businesses. While the first four assets focus on defense and preservation, this category serves as an offensive engine for new fortune creation. Sophisticated capital targets sectors with completely inelastic demand, such as waste management, self-storage, and medical infrastructure. These services are non-discretionary, meaning consumption cannot be stopped regardless of economic conditions. During downturns, these businesses benefit from stable revenues and reduced labor costs due to higher unemployment. Smaller leveraged competitors often default during crises, allowing larger entities to acquire routes and client lists at liquidation prices. The acquisition of boring, unglamorous businesses during periods of distress provides the highest long-term returns. These entities are typically undervalued during economic expansions because they lack the narrative of high-growth disruption. However, their consistent cash flows make them the most valuable targets when speculative bubbles burst. The analysis of 100 years of private auction and acquisition records confirms that crashes are scheduled shopping events for prepared capital. The financial system does not hide these mechanisms through malice, but through the assumption that they are only accessible to institutional players. In reality, the principles of liquidity, scarcity, and inelastic demand are universal economic laws. Generational wealth is built by recognizing these cyclical patterns and positioning oneself accordingly. The accumulation of sovereign debt, the understanding of bankruptcy law, and the focus on essential infrastructure are the true markers of financial sophistication. As market cycles continue to repeat, those who hold liquid ammunition and productive scarcity will continue to expand their influence. Economic dislocations are not natural disasters, but the primary mechanism for the legal transfer of the world's most productive assets. Future wealth belongs to those who understand that value is ultimately anchored to necessity rather than speculation. Preparation for the next redistribution event begins long before the first signs of market instability appear. The quiet accumulation of these 5 assets remains the most consistent strategy for surviving and thriving across multiple generations of economic change.